When you hear financial system, you probably picture a massive steel bank vault. In reality, the vault is a single entry point into a sprawling, multiplayer network of institutions. Let's start with the traditional bank. You can't just rent a building to take people's deposits. You need a bank charter, which is the explicit legal permission from the government to operate. Here in the US, we use what's called a dual banking system. That simply means a bank can get this charter from two different places. It is either approved by state banking authorities or federally approved by the comptroller of the currency. Understanding these strict rules gives us a baseline. It defines exactly what a bank is allowed to do, which helps explain why an entire separate ecosystem evolved to handle everything a bank is prohibited from doing. This chart shows the total number of insured commercial banks. Since 1980, it dropped from 14,000 to just 4,000. But the industry didn't disappear. It consolidated. The yellow banks with branches completely overtakes the green unit banks. The survivors became massive institutions. This consolidation is the result of a long tug-of-war in banking regulation. We built strict walls in 1933 with the Glass-Steagall Act. Then, in 1999, Gramm-Leach-Bliley tore those walls down, allowing banks to merge and expand. Finally, after the 2008 crisis, Dodd-Frank put new guardrails back up to limit risky trading. Loosening the rules creates a distinct trade-off. On one hand, you get highly efficient megabanks housing all your financial services in one place. On the other hand, a single institution can become so large that its failure threatens the entire system. When an industry is this concentrated, a mistake at one megabank quickly becomes everyone's problem. That vulnerability makes strict government-backed safeguards an absolute necessity to keep the economy stable. The ultimate safeguard against that kind of collapse is FDIC insurance. Before it existed, a simple rumor could cause panicked crowds to rush the lobby, demanding their money and causing the bank to run out of cash. Today, the FDIC protects individual deposits up to $250,000. With that safety net in place, these megabanks have expanded far beyond their home borders. They operate through foreign branches and subsidiaries, dealing heavily in Eurodollars, which are US dollars held in banks outside the United States. And the physical borders are disappearing for the consumer. The brick-and-mortar branch is rapidly being replaced by the screen in your pocket, with digital banking interfaces and AI handling everything. Traditional banks are larger, globally connected, and safer than ever before. Yet, even with all this reach, they leave gaps in the economy that require a completely different set of tools. The other half of the ecosystem consists of non-depository institutions. These 5 major players manage billions of dollars in capital, but unlike a bank, they do not take traditional deposits. The first major player is the insurance company. They operate on a mathematical concept called risk pooling. You can't predict if you will crash your car today, but an insurer can predict the exact percentage of a large group that will. By collecting a small premium from everyone, they create a central pool of money to pay out the unlucky few. Insurance faces 2 massive behavioral problems. First, adverse selection. Before the policy is signed, the most accident-prone individuals are eager to buy coverage. Second, moral hazard. After the ink dries, people act carelessly because they are protected, like speeding in a fully insured sports car. An insurance company's entire business model depends on screening out these behaviors. Through medical exams, driving records, and deductibles, they filter who gets into the risk pool to ensure the collective money remains solvent. The second player handles the risk of outliving your savings. Pension funds help people save for retirement. Historically, employers used defined benefit plans, promising a fixed payout and carrying the risk themselves. Today, that burden has shifted to the worker through defined contribution plans, like the 401k, where retirement depends entirely on your own investment performance. To grow that retirement money, you need the third player, securities firms. This includes individual brokers who provide everyday people with the platform and access to buy and sell on the open market. It also includes mutual funds, which pool your money with other investors to buy a diversified portfolio. On the corporate side, investment banks sit at the other end of the table, helping companies raise new capital by issuing stock. Notice the difference in function. Traditional banks are designed to safely store your money. Securities firms and pension funds are the engines we use to take calculated market risks to build wealth. The fourth player, finance companies, lends directly to consumers for specific purchases, like car loans, without holding deposits. The final player, government-sponsored enterprises, stabilizes the housing market. They quietly buy up local mortgages, ensuring lenders always have cash to write the next loan. From your car to your house, a massive percentage of everyday consumer borrowing relies entirely on these specialized entities working outside the traditional bank vault. Zooming out to look at the whole board reveals a highly interconnected web. A disruption in an obscure non-depository firm ripples through the system, hitting traditional banks that share the same underlying capital and risk. These 6 types of institutions form a single machine. Together, they manage catastrophic risk, facilitate lifetime savings, and provide the credit necessary to keep the global economy functioning. For those of you in FINAN 2020, mastering this structure is critical. To succeed on Exam 2, you need to be able to clearly distinguish between the strict depository rules of a commercial bank and the specialized functions of the 5 non-depository players. Good luck studying, and we'll see you in class.